welcome to today's 5 with Fitz. What a wild week. Yesterday's massive run higher wasn't a surprise, at least if you've been paying attention anyway. I've been like a broken record recently, telling, for example, Varney & Company earlier this week, quote, the market will be gone like a shot when there's any form of tariff reprieve or a deal or 3 gets inked, paused, or tabled. And I said dang near the same thing last Friday from Dallas during the depths of the market sell-off when I sat down with the one and only Charles Payne. You can watch both of those videos on my channel elsewhere. It is not a surprise that the markets are giving some of that back this morning. In fact, I sent out a tweet last night urging folks to remain frosty, a Marine Corps expression meaning vigilant and without letting your emotions get the better of you. We got a little bit of selling, some red on the screen this morning. So it's just par for the course. Always remember 2 things. First, investors want to buy, but what they really don't want is to get sold, as in sold out. And second, the markets have an upward bias over time, so it makes sense to play that, or play to that anyway. So speaking of which, here's my playbook. Number 1, big rallies like the one we had yesterday do not always signal an all clear. In fact, there were similar spikes during the dot-com bust, the global financial crisis of 2008 and 9, and the COVID crash, all of which were followed by more turbulence. Now, we had stock futures turn red in early Thursday today as I record as investors awaited the CPI reading at 8:30 Eastern. And we have red in early going as I record this. So what to do? Same thing we always do. Pick your battles and your bets very carefully. This isn't the end of the world, even though it's easy to think so. Chaos, repeat after me, chaos always creates opportunity, and the more the former, the more the latter. If you're a trader, there's a couple things you can do. You can buy calls. Now, calls are a bet that prices will increase. Those got very expensive yesterday as volatility shifted to the upside. And no doubt the FOMO crowd's going to be buying those this morning, which is exactly the wrong thing to do. Puts, on the other hand, are a bet that prices will decrease, and those are getting very expensive today as volatility is returned to the downside. And of course, the nervous money is going to be buying those and paying way too much because they fear the worst. If you want to be successful as an options trader, what you want to do is flip that around. The best time to buy calls is on a day like today when the markets are getting carried out feet first and people can't think about the upside. And the best time to buy puts is on a day like yesterday when they're all drooling over higher prices and the greed gland is working overtime. Now, if you're an investor, it's considerably more simple. The markets have a very defined upside bias over time, so it makes all kinds of sense, both sense and sense. Get the pun there? Couldn't resist, to focus on that. So you continue to buy the best and ignore the rest using proven tactics to harness the volatility most fear. Now, if you have no idea or how to do that or which companies to buy, I'll be here. Keep watching these videos and I'll get you covered. So most investors don't understand that. It's very, very simple. Anyway, the investing tip here really is you follow the money, not the headlines. Leaders, and I mean stocks, leaders lead for a reason. So point number 2 today, are we out of the woods? No, not until China's at the table. And that's the thing, right? China is not at the table yet, and that will be the closest thing to a wild card when it finally ultimately happens. I've got to believe that those talks between the U.S. and China are taking place very quietly and very bluntly, well off the radar screen and out of the range of reporters. But for now, both sides are going to do what they do best, posture about strength and resilience and more, sticking it to the other guy. Neither side wants to be perceived as weak. Now, the thing about that is, having spent a lot of time in China over the years, I continue to believe that Washington is severely underestimating China's resolve. So the investing tip here, the one that applies most, is that you never mistake a tactical pause for a strategic shift. The reason most investors fail over time is they lack a long-term framework and vision to get them past short-term chaos like the stuff we're dealing with now. Number 3 today, is it time to buy Amazon? Finally. In his annual letter, Amazon CEO Andy Jassy said that the company plans to spend $100 billion, up to $100 billion this year, mostly on AI and tech infrastructure like faster, cheaper AI chips, the Trainium 2, or powerful new AI tools and models like Nova, Bedrock, and SageMaker. I mean, the guys naming this stuff are almost as good as the guys named prescription medicine, but that's another story for another time. And finally, a smarter Alexa Plus that can actually do things for you, which will be good because my Alexa, my dog is smarter than Alexa at this point. Project Kuiper, I can't remember if I'm pronouncing that right, but satellites to bring internet to hard to reach places. I mean, Musk is already out there, but Jassy thinks he's going to do it anyway. It escapes me. But Jassy believes the cost of AI will come down and become more accessible as cloud storage did. And I agree with that. That is the nature of innovation. As technology advances, costs drop, adoption grows, and what once seemed out of reach becomes every day. But that's not a reason to buy Amazon, in my opinion. I think that the company is trapped in a constant cycle of Me Too, and AI is a great example. They're late to the party again. And it's always Me Too when it comes to innovation lately. B, it has an increasing number of customers who positively hate doing business with Amazon, even though they continue to shop there extensively. And C, I think that Chinese tariffs are going to be a wrecking ball for U.S. Amazon sellers and advertisers. If anything, I'm tempted to buy Putskis, but prices will decrease. Meanwhile, I suggest continuing to short or avoid the stock when there are other choices out there with less headwinds, better management, and customers who actually love them. I mean, people say, Keith, how can you say that? Well, look at the numbers. Amazon has returned 80.99% over the past 5 years, which sounds great until you realize that the S&P 500 has turned in 90.29%. Now, this is what I mean about alternatives. My favorite stock, the alternative that I would pick up instead, has returned 835.89% over the same time frame, and no doubt you see my point. So the investing tip in this case is simple. Investing successfully over long periods of time isn't just about picking stocks like people think. You've got to constantly weigh the opportunity cost of alternatives, and if needed, alter your trajectory and your choices. Number 4, TSMC, Taiwan Semiconductor, prints cash while printing chips. So TSMC's Q1 revenue just jumped 41.6% year over year to $25.5 billion with a B dollars. That is not just growth, my friends. It is a supercharged semiconductor flex. It's not random. It's AI, it's data centers, and it's every company on the planet racing to buy the future in a winner-take-all race. Now, TSMC is the foundry of choice for NVIDIA, Apple, and pretty much every chip leader that matters. Now, should you buy Taiwan Semiconductor? That's the question, right? Now, I could make the case for doing so, and a lot of people think that's a good idea. However, I also believe that there are a few other names out there with more upside, including 2 making their own purpose-built chips. And the OBA family knows all about those. So, if you're interested, I'd love to have you on board. Meanwhile, consider buying TSMC if you don't own it already and you're not an OBAer, or sell cash secured puts under $130 to get paid while you shop. Put premiums are pretty juicy right now with all the downside at the moment. So, there is that, and it's worth thinking about. And finally, this headline catches my attention. Number 5, Tesla plus Saudi Arabia equals I have rented lips today. Tesla plus Saudi Arabia equals camels optional, but billions guaranteed. Think about this for a second. Tesla is eyeing a gigafactory in Saudi Arabia because, apparently building cars on 3 continents isn't enough. Why would he do that now? Why would Musk go there now? Well, it's because the Saudis are throwing cash at anyone who can spell EV, and Musk never met a power play he didn't like. Sorry, pun absolutely intended. Couldn't resist. This isn't just about cars. Musk wants expansion. Saudi Arabia wants tech clout. Wall Street wants a story, and bada boom, we're done. I had to move my timeline out on Tesla a skosh because of most of the recent kerfuffles, but I still think $600 a share is in the cards. And I think that robotics, AI, chips, energy, all of the things that we talk about frequently are going to make that happen. They may even be worth more individually than Tesla is as an aggregate today. So the bottom line today is very simple. People think that you make your money in bull markets, but the real profits get made when bears come out to play. Now, speaking of which, personal message, our team has been going nonstop for weeks with all of the market madness, and everyone needs a brain break, including yours truly. So I've made the decision to close the office tomorrow, and I am booting everyone in our team out the door to recharge and play. So I will see you Monday, well, technically Sunday evening for the short film, and I hope to see you then. Anyway, OBAers, I want you to keep an eye on your email later today for an early edition of the AMAs. As always, let's make it a great day. Finish the week strong. You got this, I promise, and I will see you Monday. Thanks for watching. Cheers.